First announcement, I decided when we're going to have the exam, Thursday, October 2nd. That is the last class before we get to the fall break. I don't like having exams after the breaks. You'll have the exam, then you can enjoy your break. It's going to cover chapters 3, 5, 6, and 7. We already done 3 and 5. We're covering chapter 6 this week, and we're going to cover chapter 7 next week. Sometime this weekend, I'm going to post a lot of little problem videos for you guys so that you can use them as kind of practice for the exam. I'll also do a little video about the structure of the exam, which gives you guys a lot of choices on what kind of exam you want to take. Right. Now, and I'm going to post your chapter 5 homework later this afternoon. I know you're still working on chapter 3. What are we going to do on chapter 6? As you know, in chapter 5, we took project cash flows as given, and we took discount rates as given. On this chapter and a little bit on the next chapter as well, we're going to think about how to come up with those cash flows given the discount rate. We, we're going to postpone the discussion about what the discount rate should be towards the end of the semester. But for now, we're going to talk about what those cash flows should be. And there are two governing principles. And one of them is called standalone principle, which basically says we're going to treat the project as if it's a separate entity from the firm. It's as if there is nothing else but the project itself. It doesn't mean we're not going to think about the firm, but that's a general approach. The second one is uh, incremental cash flow, which means when we're calculating things like what is the sales for the project, what are the costs and things like that, we're going to think about cash flows with the project versus without. So what happens to the cash flow of the firm as a result of accepting the project? I mean, these two are going to guide our decision about what sort of things are relevant and what sort of things are not. So relevant and not relevant cash flow types. First thing we're going to talk about are sunk costs. You guys remember anything like that from your econ classes? What do I mean by sunk costs? Since you're nodding your head. Oh, okay. Sunk costs are the costs that you would have incurred and it's not possible to get them back. In our specific context, sunk costs are the costs that you would have incurred whether you accept the project or not. So these are costs that the firm would have incurred independent of decision accept or reject the project. I mean, here the incremental cash flow principle guides us. So if a cost is the sunk cost, there is no change to cash flow of the project as a result of accepting the project. Let me give you an example. Suppose the project is about a new product. You're thinking about developing this product and later on, obviously, selling it to the public and hopefully making money. But since it's a new product, you're going to have to gather some information about what sort of demand is out there before we can even think about the decision. I have to have some idea about, are people going to like this? If they do, what sort of price they would pay for it, and what sort of sales I can expect. So you're going to go ahead and hire some sort of marketing research firm, or you may have your internal people, either way. And you're going to say, it's $500,000 to you. How about you guys do a big research all over the US and maybe in the world and tell me, A, would people like it? And how much would they like it? How much would they be willing to pay for it? What sort of sales would you anticipate given different pricing schemes? They're going to write a report, bring it to you. Based on those, you're going to make projections about sales costs and that sort of stuff. But once you pay them that money, this is before the stage of making the decision. That money is paid. And whether you accept the project is not, it's not coming back. So that's a sunk cost. Obviously, sunk costs are not relevant for us. So I'm going to make that not relevant. Let's also highlight that one. Next, let's think about things like depreciation or non-cash costs. Anybody's willing to take a stab at it? Do you think we should consider non-cash costs? Remember, this is not an accounting class, it's finance. So for us, all that matters is cash, right? So given that, do you think we should ignore depreciation and other non-cash costs? In our project cases, depreciation is going to be pretty much the only one, but generally speaking, should we ignore them or not? Way back when I used to teach the MBA finance class, uh, every week I used to give them a question, and I randomly assign you to either pro that statement or con that statement, and you have to write something for it. My question always, the first question always was, depreciation, what is it good for? Absolutely nothing. So in this case, I'm asking you the same question. Is it good for anything? Why not? It's non-cash, right? Okay, now let's think about the incremental cash flow principle. If your project has, let's say, $10 million in additional depreciation, does that affect the cash flow to the firm? And if so, how? What happens when you increase the depreciation? For example, what happens to the net income of the firm? It's a cost for accounting purposes, so it goes down. All right. Or what happens to the income before taxes? It goes down. That means if this is a tax paying firm, not a nonprofit, depreciation actually affects the taxes, which are obviously relevant things, right? So depreciation is relevant only to the extent it affects the taxes. If the project we're doing was for a nonprofit firm, the firm is not going to pay any taxes anyway. So then we could ignore depreciation. But in this case, in general case, we cannot. For tax-paying firms. All right. Let's think about another category of cash flow, opportunity cost. Who remembers what opportunity cost is from your micro econ classes, which you are required to have taken before this class, Econ 230? Anybody remembers it? What's an opportunity cost? Or you just took it online and you don't even want to remember it? Now, I always have an issue with online classes, not because I don't believe that online classes can be taught effectively, but especially in this day and age, a lot of online classes are also coupled with